Okay, we've got about 12, 13 minutes left. Let's go to the floor. Yes, sir.
Thank you. If growth in China slowed down, I imagine it would impact the United States, and I suspect it might even impact the emerging markets more. So could you comment a little bit about how dependent the emerging markets are on China, or what you think the greatest dependency might be?
I can respond to that. I think if you read the newspapers, about Brazil, you might think that all Brazil does is ship iron ore to China. It's not the case. Brazil is a huge, diversified domestic economy. Exports to GDP in Brazil are like 12%. I mean, it's like the U.S. It's a very large, diverse economy. So, I think there's not so much market risk. I'm sorry, not so much economic risk directly. The market risk comes from the fact that a lot of the emerging markets, I think, are highly correlated, and any time, China, tightens or something, all of the emerging markets take a whack. I think you've got the contagion effect there. But in terms of macroeconomic fundamentals, the dependence of Latin America on China is much less than you might think. There is in Brazil a large presence of metals and mining and of oil. So Vale, the large iron ore producer, might suffer a little bit, but that's like 12 or 13% of the index. Other than that, fundamentally, there's not a real impact.
And in India, it's more competition than it is right trade or dependence.
Yeah, I'd say actually a slowdown in China might actually benefit India in terms of inflation on raw materials, fuel. I would agree. I think that the Chinese and the Indian economies are more in direct competition with each other than they are working. It's improving, certainly, but there's historically been some significant tension there.
I also think we're about to see that is China has admitted to having roughly a 9% target on GDP growth, and for the prior 2 quarters it's been right around 11. So obviously I think there's going to be a concerted effort in terms of reducing just the capacity in which they grow going forward. So.
Yes, sir. You have the microphone now.
The asset allocators are now saying that everybody has to avoid the HICs, which are highly indebted industrialized countries, U.S., U.K., Europe, and Japan. So my question is for you, David. What's your asset allocation between emerging and frontier, equity and fixed, and what was it, I guess about 7 years ago when they invented the term frontier markets?
You're asking me? Oh, I'm not a professional investor. I'm just I do it for fun, but very little in frontier, actually. I bought and only mutual funds, I should say, because since I worked for a number of years for CNBC and then as business editor of the Daily News and then Bloomberg and Forbes, all of these had requirements that we were unable to buy individual securities. We had to only buy mutual funds. So entirely funds. Virtually none in frontier markets. I didn't really find any funds that were really dramatically interesting in that, and mostly equity funds. The BRICS, basically. Latin America, very good Latin America fund, a good China fund. I happen to differ with these folks here about Russia. Russia's been very nice to me. I know they're a corrupt region, but hey, if they make me money, look, my forebears came from Russia, and they were great entrepreneurs, and I like to think the Russian people, after they were freed from the communist yoke, in fact, could actually produce some profit. So that's my very amateurish investing history compared to these professionals over here. Yes, right here, sir. Yeah, you need to wait for the microphone, though.
Yes,
so somebody give him a microphone.
With such a compelling case for many or all of these emerging or frontier markets, why bother stock picking? Why not just buy the ETFs, maybe short a little S&P against it or something? Does it matter to do the stock picking, which is a difficult thing to do?
Good question. Particularly since we haven't had any particular companies that anybody wants to name. So there's the question.
I mean, I think that idea operates well in a vacuum, and truly, the opportunity set is so much bigger than investing in the developed markets, or what we now call the submerging markets. But the approach that we've taken is the big concern for investing in EM has primarily been just the nauseating volatility. particularly during times of stress. So instead of taking sort of a rifle shot approach by incorporating a more hedged or potentially dynamic approach that can potentially also incorporate the ability to go to cash when things do get bad, would be advantageous for, I guess, keeping clients in your portfolios.
I think also if you're paying money to hire a manager is to mostly avoid blow-ups. If you're buying the beta, it's up to you, but I think that most of the value will come also from avoiding, in fact, the blow-ups, whether it's country or a corporate in the fund.
I would also say that I think that in markets, frontier and emerging markets, because of the somewhat limited nature of the information flow, also because of the sort of differing standards for accounting and reporting, you actually would probably benefit from an active manager more in a developing and emerging market than you would necessarily in a developed market. You know, it's personal opinion, but if you look at, say, the Reliance Growth Fund, it's sort of done double what the BSE 100 in India has done. That would imply some level of skill in picking stocks, and I think that should work. Not always, but.
I want to agree with what Patrick said. You know, in emerging markets, you know, they are developing, you know, their rules, you know, for the securities markets. And you know, when you're around these markets for a while, you know companies by reputation. It's the same as in this country, but I think the degrees of, you know, between, you know, good and bad can be a little larger. You have companies that are serious offenders in the area of corporate governance that everybody knows about, that you should never buy their stock, you know. And you have also a lot of mixed economy companies. A lot of there was just a massive capital offering from Petrobras, the Brazilian state-owned oil company. Okay, you know, definitely global leaders in deep water drilling, but you know, what kind of investments are they making and what is the return they are getting on those investments? The controlling shareholder there is the Brazilian government, and they want to develop their oil industry, number one. Do they want to make, you know, the best returns possible for foreign investors? Well, you know, they're not elected to do that, really. They've got other plans. So, you know, there are serial underperformers in a lot of these markets as well that, you know, I understand that ETFs are cheap and easy and quick, but over time I think they improve the opportunity set for professional money managers who know how to differentiate between the good performing companies and the poor performers.
Okay, we've got about 5 minutes left right here.
I wonder if we could talk about the value part of the equation. I can't really disagree with the growth prospects across emerging markets, but just use the Petrobras example. There's a company in Spain called Repsol that probably has the best Brazilian assets, and if you were to just only look at the emerging market assets of that company, they're probably worth more than the market value or the market cap. And so we're finding a lot of companies in Europe, ironically, whose emerging market assets are worth the entire market cap and have comparable growth prospects as they would, and maybe even better if they were just pure play emerging markets.
Well, yeah, how about the transparency in the Western companies that are investing in emerging markets?
Absolutely, transparency is much better. So in India, you have an infrastructure problem, and in China, there's a large banking and potentially housing issue, and in Mexico, crime waves, and in Thailand, instability, etc. And so
let's our panelists answer that. Anybody want to take that?
Well, with respect to Repsol, that's a very interesting example you just give, because what happened, you know, with Repsol last week in Brazil, you know, Sinopec came in and paid $7 billion for a 40% stake in their Brazil operations. And I mean, I had already gotten an email from one of my brokers. Repsol, we were expecting that to come to market. We were expecting that to float. You know, I was interested in potentially buying that stock for my fund. But, you know, China needs oil, and they went after that asset, and they got it, you know. I mean, I think the race is on for access to resources and assets. But with respect to value, I think, you know, that was a question. I would say the Brazil market overall right now is trading at a PE multiple of 13.5 times for 2010, for example, but corporate earnings growth is 30% this year. Next year, it's 20%, and the market is probably like a 10 or 11 times PE multiple for 2011. I mean, I think this is great value. Yeah.
Richard Wright with RBW Capital. The savings rate in Japan went from 18% to near 1-2%. As that, you look at Austria, Germany, Switzerland, you know, the rate's 10-12%. How do you expect the capital flows from the bonds into the emerging market equities to benefit growth?
Okay, very briefly, because we just got a couple minutes left. Any thoughts?
Well, I think it's, you know, I mean, the interest rate disparity is tremendous. I mean, you know, the policy rate in Brazil right now is 10.75%. You know, we're at virtually zero. You know, a 10-year Brazilian Treasury bond yields 11.75%. You know, we're at what, 2.5% on the U.S. Treasury. I think, you know, these emerging markets with, you know, Mexican 10 years yield over 6%. I think these markets are going to continue to be very attractive for foreign investors. And I think we may see, you know, increased measures also on the part of emerging markets to, you know, sort of limit these capital flows because it makes their currency appreciate and you know, makes their exports less competitive. They get a lot of political pressure to manage their currency.
Well, I think I see our next panel here poised like vultures to take over our seats. One last quick comment. Anybody have one last quick comment to round it up from across the Atlantic?
Yeah, just to be cautious. I mean, look at relative value all the time. I mean, today you can buy a Philippine bond 2-year at the same level of yield as Australia. So where's the value? Okay, so each time don't rush into one market because it's simply fashionable, but look at what's the embedded value of the proposition that you have in front of you.
Okay, with that, thank you very much. Remember, World Policy Journal, great publication, and we have my successors over here poised.